From Washington, this is the Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, August 26th, and you're listening to the Macrocast, brought to you by Hamilton Place Strategies and Markets Policy Partners. I'm Matt McDonald, a partner at HPS, filling in for Tony, who is out this week, enjoying his August. I'm joined, as always, by John Fagan from Markets Policy Partners, and we have one of our, not always, but regular special guests to the Macrocast, John Dick, founder and CEO of Civic Science. It's been a big week. We are going to be talking about not only GDP, which was, when was that, Thursday, but also Chair Powell's Jackson Hole speech. I have a confession for the crew here and for our listeners, is that I had to do a big staff meeting thing this morning and got a little jammed up. And I was pleasantly surprised that Chairman Powell's speech was only 9 minutes, because it let me tuck that in before the Macrocast recording on this Friday happened. So, John, everything is going to be John today, but Policy Partners, John, do you want to touch on what the chair had to say out in Jackson Hole and how the markets are thinking about it?
Absolutely. Thanks, Matt. Yeah, everybody was on the edge of their seats for this one. It was, Jackson Hole has been the venue of, major policy shifts by not just Fed officials, but global central bankers in the recent years. We've seen unveiling new policy tools. We've seen big macro policy pivots, huge pronouncements. And I think that, markets were really, anticipating the potential for something like that. And what we got in reality was a real reiteration, at least on a substantive level, a, straight down the fairway kind of reiteration of things of discussions about inflation expectations, growth in the U.S. labor market, and about the trajectory of interest rates. They're pretty much consistent with what Fed Chair Powell has said in the past. And really the big difference was more about tone and emphasis. And in that 9-minute speech, he did pack a punch with the tone. It was, a discussion about, I think the atmospherics around it were about sort of grim determination to follow through on the current policy path. And I think that really breaks down in very specific ways. He still talked about how growth momentum is strong in his view. I think that's more about there's less and less evidence to really support that. We do at labor markets are still strong. Everybody knows those are a lagging indicator, but we got some really dismal PMIs, and we've had some very, increasingly downbeat numbers in the U.S., particularly in housing, that are consistent with deterioration.
We did have GDP this week, which, it was not the first reading, but it was negative.
Yeah. But, Fed Chair Powell sort of mouthed, the Fed line, which is growth is strong. But he began to acknowledge, I think in more focused terms, a little bit more, more clearly, that the Fed is going to be inflicting, as he said, some pain on the economy as part of their inflation fight, justifying that by saying that any sustainable growth dynamic in the U.S. is predicated upon price stability. You can't have one without the other. And I think that, he made a few other sort of variations, maybe a little correction on his, after the July meeting, he talked about neutral, about yes. Rates at neutral level.
I noticed that he gave a little bit extra context to what he means by that. Yeah.
Yeah. And I think that the other point of emphasis is not really a change, but a point of emphasis beyond, this may be neutral, but we have to go further. We have to be restrictive. And the other
Correct.
Point of emphasis was we're going to be restrictive for an extended period of time, in their view. And that was, again, sort of a difference of emphasis. It's not something, totally novel. And citing sort of the message from the 70s, which is that stop-start policy, prematurely loosening puts you in an even worse place. And so,
I mean, if you told me before the speech, if you told me nothing but the fact that the speech would be 9 minutes long, I would say, okay. I mean, if I take off my econ hat and put on my communications hat, you tell me it's a 9-minute speech. That says to me, he has to give a speech, but he wants to get in and get out and kind of convey as little new information as is possible. That's right. That is what that says to me.
I think that's absolutely right. And so he can get on with the horseback riding and other fun stuff at Jackson Hole as he has, sort of done the job here. And that job really is, I think it's, he again emphasized that, look, 75 basis points isn't going to be the same, we're not going to do the same magnitude again and again. Eventually this is going to have to come down. And I think that, and we sort of talked about this a little bit before the show, this may be sort of him framing the hawkishness and pounding the table on, this determined inflation fighting so that the market doesn't get too overexcited about a downshift from 75 to 50 basis points, which he again left the door open to in September. He highlighted how much more data they're going to be able to see before September. And, and he said, it wasn't expeditious rate hikes. It was sort of purposeful rate hikes was the new, maybe purposeful is expedition is 75, purposeful is 50, who knows? But
since Tony's not on the podcast this week and he can't push back on that, I'm just going to go out and say again that I think that the fact that they don't have a August meeting is a good thing, and that he bought a little time. So in general, the markets, the treasury market, the treasury market isn't doing too much. And some of it is probably because it's a little hard to read into what's going on the front end of the treasury market, because European sovereign, right as Powell was getting to the podium, the headline crossed that, an ECB source floating 75 basis points for their rate hike in early September. And that just is clobbering the front end in German bunds and EU sovereign debt, which is exerting a pull on US front end treasury yields. But, in general, the treasury market is saying nothing new. The equity market is down, pretty, the S&P is down 2%, but it was up 1.5% yesterday. So you got to put it in context. Is this really something new? The bond market's saying, it's consistent with what we've heard. Civic Science, John, I want to get you in on this. Chairman Powell, when he was going through this, he touched a lot of bases on citing prior Fed chairs and the wisdom of the ages in his speech. He referenced in particular, I think it was Greenspan, he cited kind of the definition of inflation is when it doesn't factor into people's thinking on decisions or business decisions, which is a nice, elegant way of articulating it. Even though prices are going up, it's a non-factor. Where do you, in our consumer data and how people are feeling about the economy out in the real world, aside from kind of Fed land, what's your sense of things and where things are?
Well, I mean, I think the consumer's still really strong. I'm always careful to sort of make a monolithic statement about that because there's a couple different stories there. But overall, everything. So let's talk about inflation first. Yes, people felt it. We started reporting in late June, early July that the consumer was sort of indicating that they felt we had reached the worst point of inflation and that there was really nowhere to go but up. And all of our economic sentiment data since then has sort of echoed that. But because of the enormous amount of savings that have been accumulated over the last 2.5 years, the consumer was able to plow through inflation. And that really happened in a couple different ways. You had sort of the upper end and let's just call it the upper half of the income spectrum, where people were just willing to pay more for stuff. They were going on vacation this summer and flying to Europe, even though airline tickets were through the roof. But then you had the other half that continued to really spend at the same level. They just moved down market in terms of where they spent. So you saw people going to dollar stores, you saw people making different choices at the grocery store. They weren't spending less money, they were just buying different things. And probably the strongest indicator that we've seen, both in our data, but also in sort of publicly available data from other sources, is that credit card spending didn't increase over the last 6 months, and that's normally an indicator of, all right, people are starting to run out of their savings and starting. And now there are two stories there. At the lower third of the income spectrum, we have started to see increased credit card usage, but we've saw declining credit card usage at the upper end. So the net average was pretty flat, and that's also not just remarkable given kind of the inflation and gas price era that we were in for the last 6+ months. But we normally do see credit card spending go up in the summer. because people are, charging their vacations and other kinds of things. We've yet to see any of it. And so I think the consumer saying, yes, I notice inflation. I'm going to complain about the fact that I'm paying more for gas and paying more for chicken at the grocery store, but it has not shown any evidence of changing behavior.
Yeah, that's really interesting. I mean, it is. To go back to the Greenspan quote and the framing of it doesn't affect decisions, is that there's probably somewhere between it doesn't affect decisions and major behavioral shifts to and in between there's somewhere between maybe notch 2 is just complaining about it, and then notch 3 is some adjustments, but not a bunch of material change on stuff. And it does feel like it's again, since Tony isn't here, he's very bullish on the strength of the economy and where it is, and it does feel like the consumer's holding up.
Yeah, I had Michelle Meyer, the chief economist from MasterCard, on my podcast this week, and we talked about this, and she readily admitted that, economists and economics in general tend to look at sort of the top line numbers of things. And we know, in this country, particularly right now, there's multiple stories happening underneath that single monolithic line on a chart that it's the ups and downs that sort of are averaging out to net good right now. We have to be mindful of the fact that the lower third of the income spectrum is feeling this differently than the rest, but the upper 2/3 are spending more than the bottom third is spending less. So the net average tends to be positive. So the Greenspan thing, I get it. It strikes me as a little bit obtuse to sort of make that blanket. There are people for whom inflation is changing behavior, but it's not changing behavior in a way that they're actually cutting back spending. They're just spending differently and in different places. There's so much more choice in the market now too. The internet, the internet has been overall a deflationary innovation because people have a lot more pricing power. They can shop for things. There's so many choices out there available to them. It's not, I only have one grocery store or one retailer down the street that I'm stuck with. I can expand my horizons. The other thing that you mentioned earlier, when we look at our ESI, again, we started to see positive turns in this at the end of June, when we were kind of yelling to everybody. From the consumer's perspective, they feel like we've reached bottom, and all of our data seems to be indicating that. Since it's interesting how little the housing market seems to be impacting overall consumer sentiment right now, because it feels like over the last 2 years, the people who are in the market to buy or sell a house kind of already did. And so, yes, maybe housing prices are up and all that, and inventories are strained, whatever, but there doesn't seem to be as much demand among consumers, because if you were going to move towns because your job allowed you to do that, or remote work allowed you to do that, it seems like most people already did that, so that the negativity that the market sees in the housing prices and housing market does not seem to be impacting the consumer the same way it would have maybe 2 years ago.
Policy partners, John. The way that the markets and the Fed think about all this stuff, it's an interesting dynamic, right? They're both looking at the same data and the same real economy, right? And then the markets are kind of taking cues from the Fed and what the Fed says, and reading between the tea leaves of both what's going to happen in the real economy and how the Fed is going to interpret that in the real economy. And then the Fed is trying to calibrate their message to how the market will react to it. It's a lot of communications game theory on how all this stuff
I know
goes
that
down.
You know that I know that
exactly.
The federal, and so
it's like that scene in Princess Bride where he's trying to figure out where the poison is.
That's right.
But my question on this, it's when we think about all this, the Fed, the more that the markets and people believe that the Fed is going to squash inflation, the easier it becomes for the Fed to squash inflation and actually, let up on the brakes. So it's a completely, interrelated dynamic on this stuff. So how do we think about, as we turn to the fall and the next rate hiking cycle, is how are beyond today and today's speech, how are the markets calibrating against all that?
Yeah, the markets have, despite what you might see in some headlines and commentators and so forth about the Fed losing credibility, that doesn't show up in financial markets. The Fed's inflation fight whether you think they made a policy mistake by being too loose too long, or pivoted too late, or whatever it is, they are, once they pivoted, that was a big sea change in financial markets. And you've seen things like, if you were to have a Fed credibility problem fighting inflation, you wouldn't see the dollar rampaging northward at multi-year highs against its peers. It's at parity with the euro. You wouldn't see the Treasury yield curve inverted with the 10-year yield way below the 2-year yield. That is consistent with an idea that this Fed is going to engineer a recession to tame prices. If you're looking at TIPS break-evens, the inflation-protected Treasury securities, those break-evens are way off of their peaks earlier this year, and they're practically down. They're the 5-year, 10-year. These are in not all that inconsistent. They're above 2%, but like 2.5, 2.7. These are not inconsistent necessarily with a Fed kind of 2% give or take kind of target. They're just not that far off. And
so has the Fed reestablished credibility?
So with financial markets, it never really lost it. And so all of the things that we've seen in financial markets is when the Fed says we are going to put the screws to this economy, the market trades in accordingly. And I think that if you do have this, but this back half of the year is it's a very challenging time in this narrative, because you're going to see, very likely, you're going to see in the U.S. a peaking of inflationary pressures. We saw again the Fed's we saw the CPI and PPI for last month come in below expectations, and we just saw this morning the Fed's preferred price pressure gauge, the core PCE price index, was 0.1% month on month, below the 0.2%, way down from 0.6 the previous month. That's still elevated on a year-on-year basis. On the core, it's 4.6%, but that's lower than 4.8. That's going in the right direction. The Fed has been like omerta on improvements in inflation metrics, because it doesn't want the market, again, to get too excited about an inflation peak and about the ensuing downshift in the tightening cycle. But Fed Chair Powell, he acknowledged that July inflation looked better, but they've been at pains to say we still need more. You need multiple months in a row. So if you say market Fed downshift in tightening and an inflation peak, that's a bullish story for equities in the second half of the year. But a soaring equity market is incompatible with the kind of tight financial conditions that the Fed needs to do that. So there's sort of a self-defeating element in financial market rallies at this point that the Fed is trying to tamp down.
Let's take a short break and continue the conversation when we come back.
HPS is hiring full-time public affairs associates and analysts. We're seeking entry-level associates and analysts to join our dynamic team. Associates have immediate client exposure and opportunities for professional development while working in a fun, fast-paced, and challenging environment. Recent graduates or applicants with up to 3 years of postgraduate work experience are encouraged to apply. Learn more and apply today at hamiltonplacestrategies.com/careers.
Okay, we're back with the Macrocast. We kind of set the stage already with, some of the recent numbers, the GDP, PCE, the Jackson Hole. Looking ahead to the fall, where are both of you on kind of, can we land the plane on this stuff, where the economy goes, how the Fed and markets are thinking about it?
Well, I mean, from the consumer perspective, I'm still very optimistic, particularly going into the holiday retail season. Consumers are showing no sign of slowing down in terms of spending, and in fact, on the contrary, if anything, sort of sentiment has been improving over the last 6+ weeks, and again with no signs of slowing down. The president yesterday more or less injected $300 billion of new spending, plus $300+ billion of new spending capacity into the consumers' hands among those who have student loans. We've already finished our first study on it. We as soon as the news broke, we started surveying on it, and obviously the country's incredibly divided, and opposition to the loan forgiveness program is stronger than support. So it's sort of like 43% opposed, 41% support, but support jumps to like 72% among one group. Guess who that group is? People who have student loans. And so whether they put that $10,000 away and now they can spend it or not, who knows? But it is going to unleash, at least among some large segment of that group, some spending capacity, and that's going to show up in holiday spending to some degree. And now I can't speak to what potential inflationary impact that might have down the road. That's your expertise, not mine. But as it relates to the health of the consumer from a spending standpoint, there's no reason to be pessimistic right now.
I mean, it's certainly a expansionary policy for tuition and student debt, I would say. I mean, if you are in the market for borrowing for school, or you are a university, as soon as this round of forgiveness happens, there will start the debate for the next round of forgiveness. And so just from a behavioral perspective, I would say that that's the direction that this goes in. It is interesting. I mean, there's a big Fed study on this, an important Fed study on this a while back, of like the amount of tuition increase that results every time the Congress raises the student debt limits. And it kind of flows right into tuition. The interesting part about some of this stuff too is that from a student loan perspective is that people haven't been paying, if you have federal loans, people haven't been paying on the federal loans for years now. So it's an interesting dynamic. I think they said that in the policy that we're going to extend the federal loan repayment again. And then this time we really mean it, that you're really going to have to start paying back your loan. I forget. I think it might be end of the year. So there's a number of dynamics at work, but it's an interesting policy.
What about from a political standpoint? I mean, there's a lot of economic debate. Is it a good idea? Is it a bad idea? I mean, from a politics standpoint, this is a White House that seems to have, in some ways, gotten its mojo back over the last few weeks, and is, it's on offense. So what do you think, Matt? Is this? If you throw the political calculus into the mix, is the cost benefit analysis look a little bit better?
Well, it was a campaign promise that he made. I think that there's a sense on the left of momentum. I think to John's point, I think that there's some polarization around this. It'll be interesting. I mean, one dynamic of like the student debt component is that you have seen a movement of working class voters towards Republicans, and you've seen a movement of kind of educated elites towards Democrats. And I would expect this to accelerate. One calculus on the entire student debate exercise is that two core constituencies of the Democratic Party are students and universities. And they're pretty on opposite sides of this particular issue, where the universities want to charge more in theory, professors want to get paid more in theory, and students want to pay less for all of these things in theory. And so, kind of doing the like, okay, forget this happened type of exercise is one way to diffuse that tension that kind of, I don't think a lot of people think through in that dimension, but it's a through line tension in the party. And this is one way to kind of smooth some of those things over in ways that, like, if you were to do, for example, something more systemic to address rising student debt costs, which would be like things like, hey, the amount of debt you can take out depends on your degree, right? So like if you're a history major, you can take out this much. And if you're an engineering major, you can take out that much based on what kind of like incomes you can make on the back end and payback ability and that sort of stuff. That's the type of thing that universities would get real grumpy over real fast, right? So, there's a lot of underlying political dynamics on this that are complicated, particularly on the Democratic side.
I would add, and beyond just sort of what's the earning capacity, and I realize these two things are naturally correlated to some extent, but beyond simply the how much money will you make with that degree? It's also how much need for that role job is there in the market, right? So nurses and things short where we have labor shortages, are we prioritizing those? Again, that would probably be met with a lot of resistance from academia, but it's a fairly obvious possible solution to it. I think we felt, at least what we've watched through our data over the last 2 years, when President Trump first sort of froze student loan payments, there was always going to be a reckoning for someone at some point who was going to make the decision to turn that spigot back on, and so there was never going to be a good time to do it. There was never going to be a time to do it that wasn't going to generate some kind of public backlash to the decision. This was a bit more of a kind of a bombshell, the way it kind of came out yesterday. But it was always going to be controversial about if and when to do it. And they sort of ripped the Band-Aid off. Now, I think it would be politically a lot more challenging for them if they get to the end of December and punt yet again on it. Then I think you might start to see the electorate get kind of incredulous to exhausted by it all. But at least where we sit now, it seems to be kind of a evenly divided, such that the net's pretty much neutral.
I'll tell you the other thing that I don't think, I'm sure was part of the discussion, but executing this from a Department of Ed lender dynamic perspective is not as easy as kind of snapping your fingers. And, there was a lot of issues around like the public service student loan forgiveness programs that were implemented during the Obama administration. Like the ability of people to access those and do the paperwork and do the compliance was actually really low on the back end. So there's a non-trivial risk of a kind of ACA Obamacare-like implementation disaster on this between now and call it election day, that nobody who thinks that they're going to get their loans forgiven actually gets their loans forgiven by end of this year. And if that's a big problem, that could be a big problem for the Democrats who kind of promise this stuff. So,
yeah, taking a step back and looking at this from the sort of broader political landscape, it was the sort of end of his press conference. President Biden was walking out, and he got a question from the press about, whether it's unfair to be giving relief, and he whirled around and gave this answer, which was, I'm sure, rehearsed, but said basically, is it fair to give billionaires all the tax breaks? And so I think that really, we've seen that kind of messaging from the White House, which is, not into a defensive posture, but taking an offense. I don't know if you've seen the White House Twitter account blasting, various Republican politicians for having their PPP loans forgiven, and trying to call them out for hypocrisy on that front. But I think the bigger message is essentially like, there's no constituency for taming the deficit. There's none. And the White House is essentially saying, like, to the Republicans, hey, if you're hitting us on this, when you guys are in office, you do it. You just give out the candy to a completely different, you just give it out to a different group. You're as bad or worse is the message. And that really is, what we've seen. And there's, the serious, obviously there are a lot of the political winds are blowing and swirling around in a lot of directions. But when you look at the policy alignment of the two parties, neither one is, aside from some chatter about cutting entitlements from sort of the furthest right, that's never going to be a vote winner. It's not going to be a platform they run on, and fiscal rectitude is, I think, further and further away from where politics is going.
Yeah, it's interesting the way they applied constraints to this too, because you got, the income limit of 125 is like, that's pretty high. I mean, that's like MBA graduates who can totally afford to pay back loans. The other side of it, the 10,000 forgiveness, is actually like, most of the time student debt problems are at like low balance levels. And the reason is because it's mostly around people who didn't complete the degree but took out the debt. That's like actually where payback problems really are. That's where you see defaults and that sort of thing. So the 10,000, if you're actually trying to help people or solve problems or whatever, the the 10,000, I think, limit is not an unreasonable amount, because it's actually the low dollars that are the problem. But someone making $125,000 is like, I mean, that's pretty high for this dynamic. So it's interesting the way they've tried to parse this stuff.
That's nuanced too, though, a bit, Matt, because if you think about how much actual debt do you have? So it's interesting that they sort of I guess it's not really flat taxed it, but sort of like universalized that number, irrespective of A, actually how much debt you have, and B, at what life stage you're at. If you're making 120, if you were an engineering graduate from MIT or whatever, working at Google, you're probably making way more than 125, but let's say you're making 124.99, whatever, at the age of 26. That's a very different life circumstance than if you're 40 years old, still sitting on, $100,000 of student debt and making, right. So like the fact that it was kind of streamlined in that way was peculiar. I don't know how it would have been incredibly complicated to nuance it more than that. But it's that's why I don't think people are all reacting to this the same way. I'm like the worst Facebook friend in the world because of my job, I use Facebook as like this ongoing social experiment. So I always put these sort of like really sort of controversial statements out there that are apolitical to watch, and the level of hypocrisy around this thing. That's the stuff that always comes out. Clearly this is more about like whose decision is going to dictate how mad I am about it. Was it my tribe or the other tribe that made it? And that's just the world that we live in. It's incredibly frustrating, and you can't do anything but laugh about it, or you'd cry.
Other big trends before we have to wrap it up. It's worth touching on. We touched a little bit on the decline of gas prices in the United States, but it's worth touching on energy prices in Europe and what's happening with the markets there. There's the rest of the world economy. There is a lot of stuff going on, but John, do you want to touch on that for a second?
Yeah, this is some of the negativity that we're seeing in financial markets over the past couple of weeks isn't really about the US. It is about what's happening in Europe. And they are absolutely on, their ground zero for global stagflation. It is putting their central banks in an extremely uncomfortable position where they are the PPI last week from Germany. Usually this is a pretty, wholesale price inflation, producer price inflation in Germany. It seems like a little esoteric. Doesn't usually roil global financial markets, but it did this time. It's up like 5% month on month. The expectation was like 0.6%. This is putting like the double digit inflation in Europe and in the UK. And it's so much of it really is energy driven. When you're looking at the natural gas prices, they're just through the roof. They're now beyond the super spike level that we saw even in March when Russia began its invasion. That had calmed down and kind of went back and forth like an EKG, but is now just shooting the moon again. And some of it is just the ways in which Russia has demonstrated its willingness to be even more aggressive and use that energy supply as a weapon, to kind of tightening the taps and putting Europe on notice that this is going to be a very cold winter. But also, some unfortunate stuff, some unplanned maintenance in LNG terminals in the US and Norway. And it's all just coming at the wrong time. It's putting, as I said, and we talked a little bit about earlier, the ECB, the European Central Bank, has been trying to, President Lagarde has been trying to parse out, what's inflation, the supply shock inflation versus, which is something we can't really do that much about other than try to tame the secondary the secondary feed through of those prices. There's now discussion about whether the European Central Bank is going to have to go 75 basis points at a September meeting. Bank of England getting more aggressive. As difficult as a position as the Fed is in, Europe is in a wholly different plane of discomfort and pain, and it's just going to get worse this winter. To the extent that this spills over into crude oil, there's a lot of discussion about crude oil prices getting a follow-on boost, a mega spike as natural gas supplies dwindle. And you got OPEC talking about how they might have to tame the market by curbing supply. I mean, this is it's just outrageous, and so it's a big challenge. And it's one of the biggest macro headwinds out there for financial markets.
Well, plenty of fodder for us to talk about in the weeks to come. We're going to have to leave it there. Thanks everyone for listening to the Macrocast this week. This has been Matt and John.
Yeah, Matt, I will apologize. This would have been much easier for you if you could have just referred to both of us by our last names, but that's particularly complicated.
That's your fault. I can't do that.
Yeah, it's my fault. Actually, it's my parents' fault, so I blame them. Trust me, it's worse for me than it is for you.
Thanks everybody for tuning in. Have a great weekend.
Thank you for listening to the Macrocast. Please remember to subscribe, rate, and share.